Hey everyone, welcome back to the channel, your number one source for income-oriented investing. I got not one but two very special guests today, our returning champions, main guys from Harvest ETFs, Michael Kovac, CEO of course, and Mr. Paul McDonald, who is the chief investment officer, I believe, right? You're the one actually managing the portfolios and stuff. So a special thank you. It's rare that I get both of you at the same time. So I'm very excited about this because today we're going to talk about HHL because you got some big news on it. First of all, how are you guys doing today?
Doing great.
Yeah, fantastic. Thanks for having us.
It's my pleasure. This is going to be great. So, we're going to talk about your pretty much, I would say, your flagship ETF, right? HHL, the Harvest Healthcare Leaders Income ETF. So I know, my audience already knows about this, but I'll share my screen and just show this real quick here, just in case. So HHL has, you guys declared some really great news. You have it here. You basically declared the first distribution increase in almost, it's almost 10 years HHL has been out. So here is the announcement. So you guys are increasing the monthly distribution starting in July, starting this month here, by just under 3% for HHL. And of course, this also applies. There's also been an increase for HHLE, which is HHL with 25% leverage, just a little over 2%. So that's really exciting. HHL is really one of the biggest, most popular covered call ETFs in Canada. I believe it's the third biggest one, only behind two BMO ETFs. It almost has 1.5 billion in AUM here, which is pretty massive for a Canadian ETF. So my first question, it should be quite obvious here. So HHL, massive success, big AUM. What do you attribute the big success of this ETF to?
Well, I'll take that one. Well, it technically is one of our first ETFs that we launched. We started the fund, as you're right, it'll be October, it'll be 10 years. We launched it actually as a structured product or as a closed-end fund, which is like an IPO. And I believe it raised about $100 million that first offering. And then we found that when it started trading, there was a lot of interest. It was trading above its NAV all the time. So we realized we had already been deciding to develop an ETF business. We decided to roll it into an ETF and launch. That was basically our launch of the ETF business. And because it was, I think the first, no, after BMO, actually, they were right there, but it was one of the first ETFs in Canada in the healthcare space. I think the first that actually had a cover call strategy in the healthcare space. We just decided to build a market around that and make it a sort of a category killer, if you will, generate that great cash flow and be invested in great companies and let that time and growth work for it. And it has, and it's become very popular. And I would say, you're right, at almost $1.5 billion, it is our flagship fund at Harvest. So it's been a great success, and we appreciate everybody that's allocating to it and holding on to it.
Yeah, I mean, very popular in my community. It's known for very consistent distributions, stability. It is a defensive, type of ETF because I'm talking about the sector here, right? My
Right.
personal opinion here, I think healthcare is really the only extremely super, defensive sector because everyone needs their healthcare all the time. So very exciting. Let's talk about the distribution increase. It's not every day we hear about a covered call ETF increasing their distribution. So you guys were able to raise it by approximately 2%. How come you were able to do the increase? You must feel very strongly about it somehow. So to take me through the decision for that distribution increase.
Well, maybe I'll jump in and just maybe give a little bit of a background
Yeah.
on our option strategy. And so we do have an active option overlay on our portfolios, and we do have a maximum 33% right level on HHL. And so what we found is over the past several years, we're consistently able to generate above the required cash flow every month. With that 33% right level. And I'll just ostracize that as well with, we're going from 5.83 cents to 6 cents a month. It's a nice increase, but it is fairly modest. And it's
Yeah.
really falls within our view of we want to make sure that when we have our distributions increasing, that they're sustainable. And we go through a very elaborate process to ensure the sustainability of our distributions. And as Michael was saying, over 10 years now, we paid the same monthly distribution. The old saying, it takes 10 years to get a 10-year track record. And so we've been consistently paying. And now that we've, over the past several years, have seen an opportunity to actually increase it modestly, but still within that sustainable framework.
And
Awesome.
we paid out about 400
About
million.
450
Yeah,
million in total.
it's a tremendous amount of cash flow.
Yeah, yeah, and Harvard, you guys are known for very, very consistent distributions that rarely, if anything, never go down. They always stay the same or they increase. So this is a really, really nice surprise for anyone holding HHL or the leverage version,
Right.
HHLE. And just for context, you guys have an all-in-one diff. You have an all-in-one which
Mhm.
includes HHL. That one is also raising its distribution. We'll stick with HHL in this video, but you have a bunch of other ones, and I'll put the press release in the video description below. But you have other of your covered call ETFs where you're raising the monthly distribution, which is fantastic. So now I want to talk a little bit about HHL stock selection, right? There's, the healthcare space is pretty massive, and you guys have approximately 20 stocks. Correct me if I'm wrong. There's actually 20, right? There's 20
Correct. Yeah.
stocks in here. And obviously we'll recognize a lot of them. These are really the big cap, the big players in the space. There's no because there's a lot of speculative little healthcare companies. That's not what this fund is about. These are well-established giants. We're talking about AbbVie, AstraZeneca, of course, United Health Group, Abbott, Johnson and Johnson, L. Lilly. So take me through the process of your stock selection. So this might be a bunch of questions at once here, but I'm very curious about this. Why did you choose 20? Are you constantly getting in and out of stocks, or you have a firm belief in most of these? And another question I might have, what would make you sell one or introduce a new stock? So I'm very curious about the whole stock selection process behind HHL.
You want to start with that?
Yeah,
And then I'll, yeah.
why don't I start with that?
I know there's a lot of questions there. So.
That's a very loaded
Yeah.
question. So
Yeah.
there's a lot in there. So I'll endeavor to be brief. I will take a step back first, though, and echo your comments that you put out at the start on. There is some defensive characteristics, but really, when we look at healthcare from a big picture standpoint, we like the long-term attributes. Permanent non-cyclical factors like aging populations, developing markets, and technological innovations. That really forms our view of the sector. When we pick our 20 stocks, we go through a very structured process. There is an active overlay. We call it our DNA process. So we'll define the universe, which is healthcare stocks. So how, as an active portfolio manager, do I pick 20 stocks out of 3,000? Well, we define it. We like healthcare. We narrow it down with very simple metrics. Minimum 10 billion market cap, has options listed in North America. I have about 90 stocks that I pick, 90 stocks to choose from. From there, it's the active component. And when we look at the active component, there's a number of variables that go into the selection. There are some financial metrics that must be met. But importantly, we want to make sure that we're diversified. So when we tell people that you have a large cap portfolio of 20 healthcare companies, that's what you're going to have. But you are going to have exposure to things like pharmaceuticals, medical devices, managed care companies like United Health. So we go through that process on a quarterly basis with that sort of purview of being diversified. We also believe in diversity by style. So we want to make sure that we have our growth, our value, what we call our GARP, other factors. And so in order for us to make a change, though, we do have to have a very strong conviction of a particular fundamentals for a company. And turnover does tend to be low, 1 to 2 names a year. Generally,
Okay.
it has been working from a switching perspective, but it is a replacement. So if we decide one is going to leave, one has to come in, or if one is better, then we determine which one will leave.
That was going to be my next question. How do you determine which ones to get in and out of? Because, like you said, the turnover is not very high, which means you're not getting in constantly. But when you do decide, what makes you pull the trigger on that decision?
Yeah, so we go through that process on a quarterly basis, and probably the best way to go through this is to give an example where last summer, our view changed on Pfizer. We'd given it a couple of quarters to say, hey, do you know what, is the R&D productivity still there? Are they actually executing on their strategy? How much are they paying for their acquisitions? And as we looked at that, we just determined the outlook had deteriorated quite significantly as we looked at kind of the next 18 to 36 months for the company. So we made a decision to replace it. At the same time, we were looking at an area called the tools and diagnostics. So if you think about all of the testing and lab equipment and very specific complex reagents associated with various types of testing and diagnoses, that's an area that we wanted to increase exposure to. We like the dynamics there. There's a recovery starting to happen. So it was at that stage that we decided to exit Pfizer and come into Agilent Technologies was the stock at that time. So we will go through that process. We're always following our companies. We follow them on formally on a quarterly basis, but every month we're always looking at what are the catalysts that are coming in for the next 30 days, and that really is key to our option strategy. And to your point on the success. Success is in part by the AUM, but also in the performance, which the fund's been one of the top performing in Canada over the past one through 5 years. And in part, that's driven by that very close relationship that we have with those 20 stocks. So we know exactly what's coming down for pipeline. We can be active around our option strategy. And so to answer your question, I think, which was the first one, a long way around it, on Y20, our 20 stocks are around 2 times the size of the entire S&P TSX. So we are getting diversity, but also when we have 20 names, it really does allow us to be much closer to those companies and to understand what's coming down in the various catalyst pipelines for these companies.
And to Paul's point there, that's a very important point, to really understand the business that you own.
Yeah.
And you and I've been a follower of Buffett for many years. And if you look at this portfolio, as Paul said, there is a name or two that may drop or be changed on an annual basis, but there's a lot of names that have been in there since the beginning. And what's become very popular now that everyone's talking about is Eli Lilly, but it's actually been in there since day one. It's a 10-year holding. So if we can make the right decision early and hold on to it and review it and go back and we're comfortable with it, it'll stay in the portfolio. And that's across all of our ETFs, by the way.
Yeah.
Not just right here.
Yeah. Oh, that makes complete sense. I mean, you have Eli Lilly here. And one thing I noticed is that there's actually a lot of diversification within the healthcare sector here. You have the breakdown here. I have to say, I always commend you guys on your website. It's one of the best websites. You have the breakdown. So it's not just, the pharmaceutical companies like Johnson & Johnson, AstraZeneca, but you got life science tools and services, healthcare providers, United Health Group is a big one, healthcare equipment, supplies, biotechnology. So it's actually very diversified even within the healthcare space. So basically what I'm hearing to summarize is not only is it active management in terms of the covered call writing, but it's also active management in terms of stock selection, tracking the companies like you said. And that's always something I like to hear from my fund manager, who's actually keeping track of these companies and knowing when to get in and get out. And I definitely trust you guys with that for sure. So how often is the portfolio rebalanced? Because it is an equal weight approximately, right? So it's 20 equal weights, comes out to about 5% or so each stock. So how does that work within the fund?
Quarter.
Every quarter we go through and it is formally rebalanced. And I think you hit a great point too there, Adrian, which is, when we look at that diversification across those subsectors. And so again, having that active overlay, when we peel back the layers of that, we also look at, say, pharmaceuticals, and we love what's happening with the GLP-1 class and its implications for other companies, whether it's Amgen or Regeneron. But we want to make sure that we're not, in our pharmaceuticals, overly exposed to one particular indication. Similarly, in our medical devices, we just absolutely love what's happening with the innovation at Boston Scientific with their cardiovascular program in particular. But we want to make sure that we have, Intuitive Surgical, which is on the robotic side. And so we want to make sure that we have that diversity across the subsector, but also even within those subsectors.
Yeah, just a quick question on that. You guys are definitely following the space. The biggest, headline this year or last couple of years has been AI, right? So we know AI is really great for technology stocks and really a lot of different companies. Since you guys are really closely tracking these 20 stocks or these companies, what are your thoughts on how AI, because you hear a lot about it in the healthcare stocks as well, are you excited about what you're hearing? What are you hearing about the impacts AI could have on some of these healthcare companies, especially the ones dealing with, robotics and the healthcare tools? I mean, I'm literally seeing images of robots performing surgeries. How excited are you about this? You think this is a good thing for these stocks long term?
We were just talking about that earlier today about the some of the heart technologies that's going on right now as well.
Yeah, specific to AI, look, I think we're in inning 6 of a very long baseball game of innovation that's going on. And so AI has been involved with healthcare for many years now. And so when we think about genomic sequencing, even all the way through radiological interpretation. These are areas that are just absolutely fascinating. And so, from an innovation standpoint, I think we're just seeing just absolutely fascinating innovation. And that's not just on the medical devices, as you mentioned. It's although it looks like a robot, it's actually a surgeon in behind utilizing the tools. But robotic assisted surgery, through to the drug developments, and of course, as we were talking before, with a company like Agilent that does a lot of the testing, and becoming much more sophisticated. So one of our views on the longer term outlook for the sector is that personalized medicine. AI is really a facilitator, I think, of that as we look out, call it over the next 3-5 years.
Awesome. And all right, well, we're almost wrapping up here. One thing I do want to talk about really briefly, and this is quite boring for me anyways, taxes, only because I get this question a lot from Canadians. HHL doesn't have any Canadian stocks, so everyone's wondering, okay, what are the taxes in case I hold this in a cash account? Believe it or not, HHL, the distributions, I have the ones here from 2023. It's a very, very tax efficient fund because, as we know, we've discussed this a million times on the channel, covered call premiums are considered capital gains. So you actually have the majority of the distributions as capital gains and ROC here. So you see here, out of the total of approximately 70 cents total distribution 2023, the majority is in capital gains and ROC, which are very, very tax efficient, of course, and only because there's only about 12-13% in foreign income, because a lot of these stocks do have dividends, but they're relatively small dividends. So I just wanted to point that out for my audience who's thinking, should I put this in a cash account and a non-registered account? What will be the tax consequences? Well, it turns out very, very tax efficient distributions. Anything in that statement that I have wrong there? Feel free.
No, I think it's a very good statement, and a lot of it ties into the cover call writing and how the treatment of that income, and also on some of the foreign exchange, you can carry forward losses and offset and so on. There's all kinds of ways you can try to build your product so that it's tax efficient. And if you look back through the history, almost 10 years, it's been pretty tax efficient the whole time through. So we don't really see that changing.
Yeah, I would echo that. There's a lot of mechanics, and that's not just true of covered calls or our fund in particular. There's a lot of mechanics and moving parts within taxation. And generally what we suggest is, if you can expect to see capital gains predominantly, which is driven from the option premium. And then if it becomes more tax efficient, then or if all else being equal, we can make it more tax efficient, we absolutely will. But generally expect predominantly capital gains in Canadian accounts.
Yeah, this is very important for sure, because the yields are very high on this. You have HHL north of 8, you have HHLE, which is basically HHL with 25% leverage, north of 10, and this is not even taking in consideration the distribution increase that's coming this month. So it's obviously a big concern for many people. And just another other reminder, I want to remind my audience, there's actually 3 listings. You have HHL, which is hedged to Canadian dollar. You have HHLB, which is non-hedged. So in case you feel the Canadian dollar is going to get weaker compared to the US, you're worried about that, you would go with HHL.B. And you could still buy and sell it in Canadian dollars. And you actually have HHL.U if you want to buy and sell it with USD currency and get your dividend or distribution in USD currency. But all 3 are TSX listed. So you don't have to worry about, that 15% withholding tax. So I just wanted to point that out to my audience there. So, all right, I guess we could wrap up. I think we've covered HHL in detail here. So guys, the last 10 years have been great for HHL. What do you feel for the next 10 years, right? Because most of my audience, they are long-term investors. Do you feel like healthcare, this fund in particular, is going to be a good bet for the future?
Well, it's interesting because we were just talking a little bit about AI, and we were talking about robotics, and we were talking about all the innovations behind healthcare.
Yeah.
And it's almost like a compounding effect as you get more innovations and more discoveries, more builds on that base. And if we go back and look at, so what are the sort of fundamentals behind healthcare? Well, we've got this demographic in the Western world of people aging and needing more healthcare. You have, I don't even want to call them developing nations anymore, because they were already pretty developed, and they're getting wealthier. More of their capital is going to healthcare, which is a normal conclusion. Just as nations get wealthier, they eat more sugar too, and therefore they're going to need more healthcare, maybe more of those Eli Lilly drugs. But and then just the innovation that's going on. So you've got all these dynamics that are not getting smaller; they're only getting bigger. So I think Paul probably agrees with the next 10 years. I think they're going to be even more exciting than what we've seen in the last 10.
Yeah, I would echo everything that you said, and then I would also bring it even in shorter term, where we published some information on some valuations and some of the nearer term growth. Call it out the next 2 years. Also that kind of shorter term looks like the sector is also relatively well positioned.
Yeah, yeah. And last and final question. Healthcare is very, very, very underrepresented. There's pretty much none of it on the Canadian stock market, right? So it's Canadian investors. You got a lot of financials, energy, utilities, gold producers, not much tech, and almost no healthcare. So this is a fantastic way for Canadian investors to get into the space. Do you think getting into this space, staying into this space is a good idea for Canadians for the long term? Kind of similar question as the last one, but maybe you could just elaborate on. I would say the importance specifically for Canadian investors, get that diversification in besides financials and energy, which is basically 50% of the Canadian market. What do you think about that?
I think it's a fantastic way to be. It's a fantastic sector to be invested in, to grow your capital and to generate cash flow, especially for investors that are looking for income. Those that are younger, maybe they're not looking for income. It's a great investment, and just compound those. Use a drip plan.
Put the drip
Compound those.
on.
Yeah, put the drip on and let it compound. If you don't need the money, let it build for you and just get that compound effect.
Yeah, yeah. I have a saying all the time I say on the channel. Look, these products they're pretty much for cash flow income investors. But if you turn on the drip, you're literally kind of turning your income investment into a growth investment because you're just growing with those compounding units over time. And the best part is that let's say later when you retire or you need that cash flow, you don't have to sell or do anything like that. You just got to turn the drip off to start drawing from the income. So I love the flexibility of these products. I talk about it all the time. Very undervalued aspect that I feel personally covered call ETFs have, because you have that flexibility. So guys, it's been a pleasure. I loved having both of you here to talk about this. Very, very successful, obviously, ETF. So I'm hoping we could do more of these in the future. So thanks a lot, guys. Appreciate your time.
Thank you,
And
Adrian.
likewise, thank you.
We appreciate it as well.
All right. Have a good one, guys. Take care.
Take care.
You
Bye-bye.
too. Bye.